It's now my pleasure to introduce our featured speaker, Lee Sheehan, Head of Tax Radius. Lee leads the provision of tax services for Radius with over 20 years working in the tax compliance and advisory area. Lee has considerable experience in helping businesses manage their tax affairs both efficiently and effectively. Over the course of his career, Lee has worked with top-tier firms including Anderson, PricewaterhouseCoopers, and Ernst & Young. Lee has spent a large part of his career advising on tax issues for multinational businesses, including indirect taxes such as VAT and customs duty. In the last 10 years, Lee has worked almost exclusively with clients operating on a multi-jurisdictional basis and has most recently built up considerable experience in issues relating to transfer pricing, business models, and tax structures. With that, it is my distinct pleasure to hand the floor over to Lee Sheehan. Lee, the floor is yours. Please take it away.
Thanks very much, Ernie. Good day, everybody, and thank you very much for joining today's webinar. So in terms of tax, in an international context, it's been in the headlines quite a lot over the last 6 to 12 months, and that's mainly thanks to the big businesses like Google, Walgreens, and Starbucks. But whilst it's the big boys making the headlines, the issues affect all businesses, both large and small, when they're moving overseas. And it highlights, what that highlights is how individual countries' tax rules are now completely outdated in the context of today's business environment and the ways that we do business. So whilst the bad press actually centres around the bigger businesses, they do influence individual tax authorities' attitude and approach to businesses and international businesses. And it can often be the small and medium-sized businesses that end up under the greatest scrutiny and bearing a disproportionate amount of the cost. And that's because the biggest businesses have the resources to be able to robustly defend themselves against challenge, resources that the vast majority of businesses just don't have. So today we'll be taking a high-level look at some of the key tax issues to consider when you are looking to go overseas, either for the first time or moving into a new territory. And we'll start with the concept of withholding taxes. And this can often be something of a hidden tax. It's not like corporate tax or VAT or GST. It's something that can be hidden. So what is it? It's a tax that's levied by a fiscal authority, a tax authority, on income that's coming out of their country. And quite often there are 3 types of income that typically attract a withholding tax, and that'll be dividends, interest, and royalties. And why is it there? Well, it's basically there, particularly in a cross-border situation where funds are flowing out of a country to another country. It's there for that tax authority in that first country to be able to collect some tax in country before that money leaves the country. It might be their only opportunity to actually get some tax. So that's why it's there. And as I say, it applies on fund flows between legal entities operating in different countries. It's often related companies, but it doesn't have to be. There are situations where it applies for unrelated companies. And it applies to many sources of income, typically dividends, interest, and royalties, but it can apply to other types of income depending on a local country's rules. And the definition of royalties can be very widely drawn and, again, differ greatly from one country to the next. It does not generally apply to capital transactions, so the sale of company or sale of assets, but there may be other issues that you have to manage there. We look at dealing with withholding tax. So what is withholding tax? Well, as I say, it's a means of the tax authority of getting their hands on some tax revenues before funds leave the country. It can be a provisional tax, so it may be just a payment on account of tax that you'll be paying in that country anyway, or it can be a final tax, and that means that you pay that liability once and for all, and that is the end of your liability. Whether you can get that liability back or not may depend on a number of factors. The withholding tax liability can be reduced or eliminated, and there are various mechanisms by which that might happen. The most common one is double taxation agreements. So those will be bilateral agreements between 2 countries that allow for funds to move from one to the other, either reducing the amount of standard withholding tax or even eliminating it completely so that you don't pay any withholding tax at all. There are other mechanisms which are less common, but they are out there if a double tax treaty doesn't cover the situation. Withholding tax may not be an absolute or an additional cost. It may not be an additional tax burden. In some circumstances, all it's doing is just shifting the amount of tax that would be paid from one country to another, and we'll be taking a look at some examples of that shortly. The one thing that is for certain is that without planning ahead, there can be a real cost, or what we would call tax leakage. Some tax leakage may be unavoidable, but at least if you've done the analysis beforehand and understood, you can at least factor that into your financial forecasts. But as I said, withholding tax can be something of a hidden tax, and it may not actually appear until after the event, by which time it's often too late to do anything about it.